Hello, and welcome to a Health Podyssey.
I think some could make the same argument that if there's a value enhancement strategy by PE firms, then it behooves them to actually raise the level of care delivery up because that enhances the value and sort of engineers a better sale.
I'm your host, Alan Weil. Private equity involvement in the healthcare system is growing. In 2018, the valuation of private equity deals in the U.S. healthcare sector surpassed $100 billion, a 20-fold increase from 2000, when it was less than $5 billion. Now, some analysts are concerned that the incentive structures built into private equity financing have exacerbated practices such as surprise billing and the general trend of increasing healthcare prices. Despite the increased presence of private equity in healthcare, there's been little systematic examination of its scope, and even less analysis of its effects on access and spending. The role of private equity in hospitals is the topic of today's Health Podyssey. I'm joined by Dr. Anaeze Offodile, an assistant professor at the University of Texas MD Anderson Cancer Center and a fellow at the Baker Institute for Public Policy at Rice University. Dr. Offodile and his co-authors published a paper in the May 2021 issue of Health Affairs that characterizes private equity acquisitions of acute care hospitals from 2003 to 2017. They found that private equity acquisitions occur predominantly in the mid-Atlantic and southern U.S. and are more likely to be of hospitals that are for-profit, in urban areas, and have larger bed sizes, more discharges, and more full-time staff. Dr. Offodile, welcome to the program.
Pleasure to be here, Alan. Thanks for having me. And on behalf of my team, we're excited to be here.
Yeah, we're so happy to have you joining us in this conversation. So I'm not sure all of our listeners have thought very deeply about the term private equity that they probably hear every once in a while in the news. What is private equity investment?
So private equity really can be thought of as an alternative investment class, so sort of removed from the public markets that usually sources funding from big institutions. So you think of university endowments, foundations, and or high net worth individuals. And the business model is to use this capital to direct investments in companies, public or private, for the purpose of gaining control so they are able to drive the day-to-day operations in a way that over time will sort of lead to revenue growth potential and value enhancement. So at the time of a subsequent sale, about 3 to 7 years, there is sort of a profit that's returned back to the limited partners, the investors, and the fund.
So just to be clear, this investment it tends to be for a limited amount of time. The idea is you acquire, you increase value, and then you sell.
Correct. Yeah. So, and I think that sets up one of the things I'd like to talk about is just how those three things sort of set apart private equity from other actors in the healthcare space.
Well, I was just about to ask you, so why would it matter if private equity is involved in a hospital finance? And it sounds like you were just about to tell me.
We think sort of private equity, we just call it PE firms acquiring hospitals, we think is interesting and why it's important for two things. First of all, I think sort of it raises questions as to the value proposition intrinsic to healthcare. So I think proponents of PE behavior in healthcare would say that sort of the prevailing inefficiencies in healthcare, which we all talked about and written about, waste, redundancies, those are actually opportunities for these firms where they can bring in sort of managerial discipline and sort of financial and operational engineering to sort of right the ship or course correct somewhat. So that's one argument. And then how this plays out is to be determined. But I think secondly, and you touched on it, it raises sort of first order questions as to sort of what are the type of economic incentives that need to be aligned in healthcare to sort of engender high quality outcomes. So those are two big questions that sort of at least points of concern or importance to healthcare.
Now, about 1 out of every 5 hospitals in this country is investor-owned or for-profit anyway. The majority are nonprofit, and then there are also government, publicly owned hospitals. So why is PE different from just the general matter of hospitals being for profit?
So we think that PE firms and their acquisition of these health systems along three elements are sharply different from anything else in the healthcare space. So number one is the reliance of debt on debt. So it's called a leverage buyout. So PE firms tend to acquire very mature businesses like hospitals and health systems. So to do that, they use what's called a leverage buyout, which is about, numbers differ, but about 20 to 30% equity and the rest 70 80% debt. And and that debt is typically collateralized by the assets of the target hospital health systems. So that's interesting, number one. Number two is this reality that PE firms sort of have the portfolio company, which is the target entity, for a short period of time, with which they can sort of engineer the operational changes to enhance or extract value. So that time bound of 3 to 7 years is also interesting. And number three, PE, there's almost sort of a primacy of returning large returns to the investors in these firms. So like sort of these institutional investors or high net worth individuals sort of are able to accept a long period of illiquidity, so an order of 10 years, with the expectation that they'll have really high annualized returns on the order of 20% that outperforms the public markets. So those are three sort of business realities that PE firms sort of deal with that we think set apart from the usual for-profit actors in healthcare.
Now, I know this isn't really a business podcast, but we are talking about the business of healthcare. So let me just make sure I understand the first of those and what the three together mean. When you say there's a lot of debt, presumably that's fairly risky debt, so they're paying a pretty high return. Is that right? If you're one of the the holders of the debt in a PE transaction?
So the key nuance there is that debt is collateralized by the target or the acquired hospital system. So that's the first point of interest that was surprising to me. And the reason why they use debt or leverage is the way that's handled tax-wise is favorable for them. And number two, that does increase the return. So like, if you finance through debt, and you make a profit, then the profit functionally is significantly increased than if it was totally acquired by equity. So the leverage drives the amount of returns, or it sets a pretty high ceiling of returns for these transactions.
Okay, that makes a ton of sense to me. So really the combination of these elements says for those who are providing capital to these PE transactions, and again, forgive me, I may get the lingo wrong because I'm not a finance guy.
I'm working on lingo myself.
You're tying up your money for a while, but you're highly leveraged, so you're really looking for very high levels of returns, and those returns have to come from the proceeds of whatever company that you've invested in. So what makes it different from standard private ownership is the need, in order to be successful, to throw off pretty significant amounts of money through either the income of the enterprise or the value of the enterprise going way up in a short amount of time.
Correct. Yeah, and as a follow-on to that, Alan, it raises questions in my mind as what sort of behaviors on the part of these owners, PE owners, does that sort of incentivize or promote or reward, right? So that's why we think it's an interesting sort of paradigm to look at in healthcare.
Yeah, so after we get a little bit of a better sense of where the PE investments are occurring, I really do want to get into this. After all, this is a healthcare system designed to promote health, and are we worried about its ability to do that if this kind of money is involved? But before we do that, just to put this in the context, your paper that we published was on hospitals. As you said at the outset, private equity investment in healthcare isn't just in hospitals. Can you give us a little bit of a broader picture of where PE investment is occurring?
Yeah, so it tends to run the whole gamut, actually, Alan. So, PE investments go all the way from retail clinics to nursing homes to increasingly physician practices, both specialty and sort of general practitioners, to hospice facilities, to hospitals as we investigate. So it really runs the whole gamut of the sort of healthcare value chain, so to speak. And I think this activity has increased over the last decade, certainly since 2010. And I think for all this activity, we thought that it may warrant some close examination without presupposing the effects, either positive or negatively, but just characterizing it. And that's how we did this paper. Largely descriptive is to sort of paint, do an environmental scan and paint the contours of PE activity. So then we can now sort of tease out potential, or really hypothesis generation, and then focus in on sort of targeted questions later on.
And you mentioned it tends to focus on mature sectors. So this isn't like venture capital coming in with some brand new startup that's disrupting the world. This is established businesses with established revenue and spending patterns saying we can do better.
Classic, so, exactly right.
And why did you focus on hospitals?
So great question for a couple of reasons. One is there's very little work in this area. So the bulk of the activity has been really actually working in health affairs by David Grabowski, looking at nursing homes. So there's a decent footprint on nursing homes. Increasingly now, physician practices has been a point of research interest. But there's not a lot of activity, save for one paper that just came out last year, that really has addressed hospital systems. So that was interesting to us. So there's a gap there, we thought. Number two is, I think why hospitals are interesting is beyond that's my practice setting. There's also the fact that we're able to crosswalk to claims and administrative data sets and now begin to say, okay, what's the impact on the things we all care about? Spending, access, quality, patient experience, in a way that you can't easily do, if at all, with other sort of health delivery or provider sectors. So that was the second reason. And the third reason, this is, we thought, maybe of a stretch, but we think that sort of hospitals are actually particularly attractive to PE firms because they have these fixed assets. So they have real estate, they have land, they have technology that I think in some ways almost guarantee an exit or value creation because they have those things that can be deployed.
Well, I'll give you a fourth reason. It's more than $1 trillion a year of national health expenditures and about a third of all the spending in healthcare. So as big as nursing homes and physician practices may be, if you're looking for where the money is in healthcare, you kind of have to look at the hospitals. Well, I'm really eager to get into the descriptive findings, as you pointed out, and then the implications, which you've teased a bit. We'll talk about those after we take a quick break.
Before hitting the floors of Congress, health policy begins in the pages of Health Affairs. Stay up to date with the latest research and insights by subscribing to the leading health policy journal. Subscribers have exclusive access to Health Affairs research, ahead of print articles, and resource pages. Subscribe today by visiting our website at www.healthaffairs.org.
And we're back. I'm speaking with Dr. Offodile about the role of private equity in hospitals within the healthcare sector. Your paper gave a lot of information about where you see transactions involving private equity. So let's just sort of start with the basic characteristics. You compared hospitals that were acquired with hospitals that weren't acquired, and you found some differences. What are a few of those differences?
Right. So we saw that on average, hospitals that were acquired by PE firms tended to be bigger based on bed size, tended to be, like you alluded to, situated in urban areas. They were overwhelmingly for profit. And a lot of that was reflected in the HCA deal by Bain and KKR.
Actually, let me stop you there, because that's kind of a big footnote here. So there is one transaction that dominates this period. And just say a little bit more about it so that our listeners know what that is.
Sure. So there was an acquisition by several firms, but notably KKR and Bain, that involved HCA, so based out of Tennessee, Nashville, Tennessee, in 2006-07, I believe, around that time period. And that deal, sort of, because it was a health system, really accounted for over 50% of the total hospitals represented in our sample. So that sort of drove a lot of the results, although we did do subgroup analysis where we teased that out, but that deal drove a lot of the directionality of our results. So I think we did have to acknowledge that as well.
Yep. Sorry to have interrupted. I just that HCA deal is such a presence in this analysis. So you were saying, what are the characteristics of those who were acquired?
Right. And so they tended to be bigger based on bed size, have a for-profit orientation, and over time sort of reflect more patient flow. So based on discharges compared to non-PE acquired hospital. And interestingly, they tended to have a better sort of antecedent financial performance compared to non-target hospitals, looking at margins and cost to charge ratio, and that performance tracked better over, so we just sort of looked at the study period of 2003 to 2017. So over the study period, they tended to perform better as well. So I think what this sort of, and I'll say lastly that there were some shifts, discrete shifts in staffing levels. If you think about nursing and total FTEs, that we could sort of pick up a signal in looking at the data. Specifically, PE acquired hospitals tended to contract or not expand FTEs, nursing and total staffing over time compared to non-target hospitals. So those are the main things. And I'll say also, there seemed to be a pattern where a lot of these deals happen in the Mid-Atlantic and southern United States with not a ton of footprint in the sort of Midwest or Pacific Northwest or the West Coast, which sort of strikes me as being non-random and sort of raises questions to like, what's driving this? Is it demographic shifts largely? Is it sort of a footprint of for-profit hospitals and faith-based institutions? These are all inferences, but it does sort of invite those sort of questions, certificate of need laws as well. So I think it was a very rich sort of investigation that sort of raised more questions and provided answers, which is always sort of what you want in something like this.
Well, yeah, you're very clear, and I want to be clear here too. I mean, this is a sort of a stage-setting paper. It describes the universe, and then it raises questions, and you're going to have to do additional analyses, and other people will have to use these data to do additional analyses to address some of those questions. I was struck by a couple of elements there. There has sort of been this mythology around the struggling hospital. And that, they're about to go under and someone comes in and rescues them. It looks like that's not what's going on. Say a little more there.
That's perfect. So, I think, Alan, there's always a temptation to sort of anchor to anecdotes or whatever is in the news. So I think classically there's the Hahnemann experience in Philadelphia. And I think that's fine. But I think we want to be certainly very disciplined in how we sort of did the environmental scan. And you're right, what we did see is the prevalent narrative that PE firms sort of come in to a distressed asset and sort of take over and either extract value or enhance value to be determined, and then sort of engineer a sale. That did not seem to play out. A lot of our hospitals were fairly healthy financially pre-acquisition. So we looked at the year prior to the PE buying the health system. So they're all doing pretty well based on margins and cost to charge ratio. They were big and they were in urban areas. So it certainly threatens that narrative a little bit that may not be the case. We certainly did see reports, and we put in the appendix, and I'll point readers to that, where there were sort of distressed hospitals that were acquired by PE, but that was not the majority. That was certainly not the norm. That's, I think, probably one of the big take-home lessons for us as a group was actually exactly that.
So the dominant story from a data perspective is these are relatively healthy hospitals with good balance sheets and good cash flow. And PE comes in, and going back to where we started, it has certain imperatives for what it's got to deliver to those who are making the investment. What would you want to know to figure out whether or not the PE investment was good or bad? That's a very simplistic language, but helpful or harmful or patient supporting or patient harming? What's the next stage of understanding what the implications of this PE activity are?
So the way we're approaching this, so the next stage is to sort of build out, using claims and administrative databases, line of sight on the things we all care about. So how does PE have or play out with respect to workforce implications? So specifically staffing levels, nurse to patient staffing ratios, and also, quite frankly, nursing intensity. Like what happens with that? As you could imagine, most hospitals tend to be the largest employers in the municipality. So if in our study period we saw a contraction or less a less increase over time, then is that reproducible with like an econometric proper analysis? And if so, what questions does that raise with respect to quality? And I think the type of things we will need to really make a robust analysis is basically more transparency, especially around at the time of the deal. What are the hospitals or the facilities that are part of the health system? And also at the time of PE exit, what do things look like? So I think it was really so. We say in the paper that one limitation is a lot of these, it's private equity. A lot of these deals are private, so we had to do a lot of sleuthing to tease it out. Worth it certainly, but I think more transparency will be key because these deals are not under the same purview that you think about for horizontal consolidation or M&A activity. This is separate. But the behavior may be the same or even more extreme or less, but certainly warrants closer oversight.
Yeah, I was really struck by that, and I guess I just want to put a little exclamation point. I mean, you had to do some serious digging to get the data, and there's still limitations. But as you pointed out, these are changes in ownership structure, but they're not mergers that would get the scrutiny of the typical antitrust entities that are worried that too much of a certain commodity is being sold by one entity. So what are the reporting requirements here?
Most deals, and we have to go through this, is something called the SEC 10K form that sort of most transactions are required to report. I mean, really like anchored around that. And once able to identify from that, the health systems, the hospitals in the health systems, we then sort of crosswalked to other data points, which we lay out in our paper. So I think more transparency, public transparency, and that will involve sort of creating a data set, unclear who will manage that. But I think sort of more public transparency as to at the time of the deal, what are the hospitals contained with it and facilities, whether it's ER or hospice. I think that will be helpful because I think the key thing is really understanding for these facilities, how do they perform along the metrics we all care about. I will say that sort of one thing that struck me was in 2017, 11% of all patient discharges were from a hospital that had a history of PE ownership. I mean, that was incredibly fascinating to me. And when you think about within those hospitals, the patient flow, so 11,000 sort of patient discharges compared to non-PE of 9,300. Margins of 7.4% compared to a negative margin non-PE hospitals. I mean, this really has an impact that is worth sort of line of sight on by everyone, I think, administrators, researchers, and regulators.
Yeah, so, you again have been clear that this is just sort of foundational data, but obviously you went into this inquiry with some concerns. I shouldn't say obviously. It sounds to me like you have some concerns about potential negative consequences, or maybe there's some room for some positive. There's so much attention paid sort of to the macro question of how much we spend on healthcare. And certainly if the presence of PE is driving up prices and causing out-of-network bills to go up, that's a cost problem.
Correct.
But how might you, as a clinician, also think about the quality of care problem?
Correct. And I will say that sort of our group, we sort of had no bias coming into this. I think, speaking for myself personally, I think like a lot of things in healthcare, I would expect the data to be mixed. I think there will be some positive effects in some contexts and negative in others, and on average, probably mixed if I was to guess. I think the interaction with quality is if, like we've established, that sort of those three things, the exit, the primacy of limited partners, and the debt leverage buyout, sort of may drive sort of certain behaviors in excess of what we see in a typical for-profit actor, right? And the question becomes, are there unintended consequences or trade-offs invited due to sort of pursuit of profitability? I think someone could make the same argument that if there's a value enhancement strategy by PE firms, then it behooves them to actually raise the level of care delivery up because that enhances the value and sort of engineers a better sale. I think you make equal arguments, right? So I think PE firms could say, look, we're going to come in and streamline processes and get care quality up, improve our performance on Hospital Compare, on Leapfrog, and that sort of, I think that's a credible argument that can be made. So I think and with great humility in seeing that sort of exploratory results and how it challenged the prevalent narrative, we're glad that we took this sort of staged approach, and I look to see what we find, which we're doing now with respect to quality, spending, access domains.
Well, I really appreciate you answering it that way. So there clearly are potential upsides. We just don't know if they exist. And in many respects, it sounds like similar conversations we have about consolidation in general, which can increase the economic leverage of an institution, but can also create potential for alignment and efficiency and clinical information sharing that could be positive for patients. And it's an empirical question whether or not it is. So I have to ask, as we wrap up this session, you're a surgeon. This
Correct.
Isn't exactly what you talk about in the surgical suite. How did you come to focus on this area in your work?
Thank you, Alan. As you graciously introduced me, so I'm a fellow at the Baker Institute, a think tank at Rice University, and I'm also a fellow at National Academy of Medicine in Health Policy as well. And the way sort of we came on this topic is I did a series of papers with the second author, Marcelo Cerullo, where we looked at hospital consolidation and how it interacts with the price and the volume of breast reconstruction. And the reason why I picked that was, in some ways, we thought of breast reconstruction as being shoppable in a way that other aspects of cancer care delivery were not. So it's preference sensitive. It's not acute, particularly. It's not widely available. So it does lend itself to sort of a market good in some ways. And what we found actually was, the market, the invisible hand, so to speak, does indeed drive the volume and pricing around this service. So then we thought, okay, could we sort of uncouple the market a little bit and think of it as for-profit and nonprofit and see if there's any sort of interaction there. And we came to realize in looking at the literature and a lot of the work in health affairs and the journals that sort of maybe that dichotomy is not as clear as we would like to think or certainly admit. I think that the evidence is pretty robust at this point as to sort of behaviors by those two entities. So we thought, okay, what is an actor in the healthcare space that maybe may provoke or at least sort of elicit a true distinction in behavior? And that's how we got to private equity. And then sort of it's been a 2.5-year journey, and certainly more to come. And thank you for the platform. And certainly my team across Duke, the Baker Institute, and MD Anderson, we're pretty excited for the platform at Health Affairs.
Well, Dr. Offodile, it was really great to get to meet you and hear about your work and what motivates it and how you got here. I'm looking forward to a lot more. You've clearly found a topic that is both important and interesting in healthcare, but also clearly gets your interest going, which is the best kind of research of all. So thanks for joining me today on A Health Podyssey.
Thank you, sir. Thanks
for listening. If you enjoyed today's episode, I hope you'll tell a friend about A Health Podyssey.
Health Podyssey is produced by Health Affairs, the leading journal for health policy research. The team behind the show includes Patty Sweet, Jeff Byers, Julia Vivolo, Sarah Kolk, and Sue Ducat. Like the show? Subscribe to A Health Podyssey on Apple Podcast, Spotify, Stitcher, Google, or wherever you listen to your favorite podcasts. Thanks for listening, and have a great morning, day, or evening.